Most people think investing is about picking the next big stock. It isn't. The real game is choosing the right building blocks and then repeating boring decisions for a long time. Today, I'll explain stocks, bonds, and commodities in plain English, what they are, why they exist, and how normal people actually use them. By the end, you'll understand what each one does, what risks come with it, and how they fit together in a sensible portfolio. Let's start with stocks. A stock is a small piece of ownership in a company. When you buy a share, you're basically saying, I want to own a slice of this business and participate in its growth. Stocks can reward you in two main ways. First, the share price can go up over time if the company grows. And second, the company might pay dividends, which are cash payments to shareholders from profits. Over the long term, stocks tend to rise because businesses tend to grow. They innovate, expand, increase sales, improve efficiency, and raise prices over time. That growth flows through to profits and, usually, to share prices. But stocks are also the most emotionally difficult part of investing because they're volatile. Stock markets can drop 20%, 30%, even 50% in certain periods. And that doesn't automatically mean the world is ending. It often means expectations changed, investors panicked, interest rates moved, or the news cycle spooked people. Markets are forward-looking and highly emotional. This is the key point. The long-term benefit of stocks comes from being able to hold through the short-term chaos. If you panic sell during a downturn, you lock in losses and you miss the recovery. And that's how the best asset class becomes a bad experience. So generally, stocks are best suited to long-term goals. 5 years plus, 10 years, 20 years. The longer your time horizon, the less the short-term drops matter, because you have time for the market to recover and keep compounding. Now let's talk about bonds. A bond is basically a loan. When you buy a bond, you're lending money to a government or a company. In return, they promise to pay you interest and to return your original money at the end of the bond term. So a simple way to remember it is, stocks are ownership, bonds are lending. Bonds are mainly used for stability and income. They tend to be less volatile than stocks, and they can cushion the blow when stock markets fall. In many portfolios, bonds exist to reduce the size of the roller coaster, not to make you rich quickly. But bonds are not risk-free. They have two big risks you should understand. The first is interest rate risk. When interest rates rise, existing bonds often fall in value because new bonds are issued with higher interest rates, and investors prefer those. So older bonds become less attractive unless their prices drop. The second is credit risk. If the borrower is a government or a company that runs into trouble, there's a chance they can't pay interest or return the loan. Government bonds from stable countries tend to have lower credit risk, while corporate bonds, especially lower quality ones, carry more. So bonds aren't exciting. They're the seatbelt. They can reduce the impact of crashes, and in many cases they provide a steadier return stream, especially when you're using your portfolio for spending. Bonds usually become more important when your time horizon is shorter or when you're approaching a stage where you'll need to withdraw money. If you're relying on the portfolio to fund your lifestyle, you typically want less volatility, because big drops just before or during withdrawals can hurt. That leads into a simple idea. The closer you are to needing the money, the more stability matters. Now let's talk about commodities. Commodities are physical resources like gold, oil, natural gas, wheat, copper, the raw materials that the world uses. You can invest in commodities through commodity funds or ETFs, but you're ultimately getting exposure to the price of that resource. Commodities are different from stocks and bonds because they don't produce cash flow. A company can grow and pay dividends. A bond pays interest. But a commodity doesn't generate earnings. Its return mostly comes from price changes. So why would anyone own them? The main reason is diversification. Commodities sometimes behave differently from stocks and bonds. They can do well during certain inflationary periods because raw material prices often rise when inflation rises. For example, energy prices can spike, or precious metals can become more attractive when people worry about currency value. But commodities are also volatile, and the long-term expected return is less straightforward than owning productive assets like businesses. Commodities can go through long periods of poor performance, and the price is driven heavily by supply and demand, geopolitics, and economic cycles. So for most people, commodities are not a core wealth-building engine. They're more like a seasoning, if used at all, rather than the main meal. Now, let's bring all three together. Think of a portfolio like building a house. Stocks are the growth engine. They're the part that historically has done the heavy lifting for long-term wealth. Bonds are the stabilizer. They can reduce volatility and help you stay invested, especially when markets are rough or when you're closer to needing the money. Commodities are optional diversification. They might help in specific scenarios, like inflation spikes, but they're not usually the foundation of a beginner portfolio. Here's a simple rule of thumb. If you're investing for the long term, and you can genuinely leave the money alone, you'll typically lean more towards stocks, because time is your best risk management tool. If you're closer to needing the money, or you know you'll panic during market drops, you'll typically want a larger bond allocation because staying invested matters more than chasing maximum returns. And commodities? Most people can ignore them at the start. If you later want a small allocation for diversification, that's a choice. But you don't need it to be a successful investor. Now, a very important warning. None of these assets are good or bad on their own. The problem is mismatching the asset to the goal. If you put money you need in 2 years into stocks, and the market drops 30%, you might be forced to sell at the worst time. That's not the market's fault. That's a time horizon problem. And if you invest everything in ultra-stable assets for decades, you might miss out on the growth needed to beat inflation and build wealth. That's not safe, that's just slow. So the real boring investor approach is this. Match your investments to your timeline, diversify across assets, keep costs low, and stick to the plan. To close, here's the simplest summary. Stocks. Ownership in companies. Higher long-term growth potential, but higher short-term volatility. Bonds. Lending to governments or companies. Typically more stability and income, but still affected by interest rates and credit risk. Commodities. Physical resources. Mostly diversification and inflation sensitivity, but no cash flow and can be very volatile. In the next video, we'll take this one step further and talk about the thing most boring investors actually use to invest, index funds, and why they've become the default tool for building wealth without overthinking. If you want the boring path to getting rich, subscribe, because this channel is all about simple portfolios, long-term habits, and making investing as straightforward as it should have always been.